Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So that, in effect, really was part of the implicit weak dollar policy before. The weak dollar policy created this symbiotic relationship really with the Asian countries. We bought more and more goods from them at cheaper and cheaper prices, so the relative purchasing power for the U.S. consumer was increasing even though his dollar was going down. That whole recycling of those excess reserves from the Asian countries back into the U.S. economy was then subsidizing interest rates, creating more liquidity for the U.S. consumer. So we were creating that self-generating type of policy that boosted up financial assets, and we saw stock markets soar, we saw housing prices soar, and it led to the fact that consumers continued to borrow more and were concerned because they had all these assets. Their wealth effect was very, very high. The idea is that the U.S. government right now wants this as additional stimulus to the world because they know they can't do it all just through debt. So that's kind of the implicit weak dollar policy in play here. Again, the same chart. I guess I didn't have to go back. I could have shown you this chart right here. But again, showing the relationship. U.S. dollar, world reserve currency, it is a lubricant for all global markets. Whenever we've seen an improvement in the U.S. current account deficit, we've seen major global problems. The U.S. current account deficit started to improve in 1987. We had the U.S. stock market crash. The U.S. current account deficit started to improve in 1990. We had a recession in there. In 2000, the U.S. current account deficit started to improve, and then we had the NASDAQ crash. So we've seen, and you can go back and look at this, and we've seen this over the years, when the U.S. current account improves, it just means U.S. dollar-based liquidity is coming out of the world, so therefore global asset markets tend to get tighter, and we're seeing that. And the idea of pushing more dollars out there from the U.S. government and creating that deficit again, unfortunately, current account deficit, to do it because of the world reserve currency is part and parcel to this. That's why, as I said earlier, the real key global macro policy problem of the world is how do we rebalance? How do we rebalance this global economy and make this transition without creating all this disruption of more balanced growth, so the Eastern economies of the world start importing some of the Western economies of the world's products, and of course making sure that the Western side of the world, consumers start to save and create a pool of savings domestically for the U.S. economy, so we don't have to continually draw on international players to fund us and become beholden there. That's really the game in here, and a rebalanced global economy would be better for everybody. You'd have a lot less volatility going on, and again, you'd have more balanced growth. You'd have less concern about trade frictions, and you'd have a more normalized market, especially in Asia, where I think what is really going to be key is this idea of creating a consumer market. Because if they unleash the consumer in Asia in a big way, then the Asians don't need to suppress their currency in order to drive exports. They can live with higher currency values. So we get into less currency manipulation. We get into more balanced trade. It really creates a better world, so to speak, from a global macro standpoint. But getting from A to B is very hard. But we were happy to see that that's really back on the table at the G20 this weekend, as opposed to just regulation. The idea of the U.S. reserve currency being in doubt, again, is in the play here. The status U.S. losing its world reserve currency. I just want to make a couple points here. First, just to tell you what it does. The U.S. as the world reserve currency means that countries around the world have to hold a certain amount of dollars to buy goods. To do cross-border trade, most of it is based in dollars, so they need dollars. To buy, capital flow is based in dollars. Cross-border capital flow contracts, big ones, are usually dollar-based. And also you have oil and other commodities that you have to purchase as a country are almost always priced in dollars, so therefore you have to hold dollars to buy them. So just given the fact that other countries have to hold dollars, no matter how irresponsible the U.S. government has been, and they have been incredibly irresponsible, especially having this reserve status. They've used it and abused it in a big way. It really gives them it gives the U.S. a lot of financial and political power because of it. But again, because it's continued to be abused, I think this is the first time really in terms of the major dollar bear market that we've had a question of the reserve status going away. Now, keep in mind, you don't just flip a switch and lose the world reserve currency status. There's got to be another competitor out there, and this usually takes many, many decades to happen, and I think it will this time too. There's no doubt, though, if the power continues to shift to the Asian bloc and shift offshore, and if the euro survives, you're going to see the U.S. dollar as a reserve currency start to decline. Its role in the world will start to decline naturally as trade and power shifts to other regions of the world. This doesn't mean that the U.S. reserve currency status is gone. It just means it's declining somewhat. You'll see less proportion held in dollars, and over time it will tend to pressure the dollar. But same token, if we create more balanced growth around the world because of the U.S. losing some of that status, meaning going from being held 65, 70%, you may again have less volatility in the global currency markets going forward. So it's not necessarily a bad thing. Where it becomes a bad thing is if this idea that the U.S. is just going to continue and brutalize, I say brutalize the treasuries by pumping more and more debt out, and if we're in this idea that we want to radicalize the U.S. economy in a big way, and all of a sudden the world finally wakes and says, you know, we've been worried about the U.S. treasuries for a while, and as we watch the U.S. government continue to abuse this status, you know, maybe the U.S. Treasury market isn't as safe as we thought it was. And there's the idea of this sentiment impact getting this ball rolling. And what you would see there, you would probably see, you start to see some of the major commodities and oil at first probably as really a giant trigger. You'd see pressure on the treasuries before this, but we'd see, you know, move from some type of basket. OPEC may move to a, you know, more basket type currencies for oil. And that would be a faster chipping away of the reserve status. Again, not necessarily because of major competition, but because of the U.S. just continuing to abuse it. So it's something to watch. Right now, the central banks hold about almost, I think it's close to 70%, 66 to 70%, big difference there, I'm not sure, but in terms of how you value the dollar or where you value the dollar here. But you have a major portfolio holding still in U.S. dollars, so even if that shifts 10%, 20% very, very quickly, it's going to be a very, very major hit to the dollar, and we think the treasuries is where you'd see that. When I keep saying there's not a competitor, there really is no competitor for this. The euro is really not in a position to be a competitor from a world reserve currency market because of the fact they don't have the depth of a common bond market. They have different issuances in the different countries and different credit liabilities. And for them to really become a serious challenger for the U.S., they would have to build a deep credit market that challenges the U.S. treasuries. I don't think Germany wants to do that, because if Germany does that, agrees to a common debt issuing in Europe, they're going to take the hit from it, meaning they're going to have higher interest rates on themselves to create such a thing, and it doesn't make sense for them. So I think the euro, if it survives, will continue to grow around the edges as more and more trade is done in the European region, and countries like Russia and the Baltics just allocate more and more central bank reserves to the euro. China's not ready yet. They're not even close to ready. But China, I think, definitely wants to take the role, and that's why they've already started the political ball rolling here against the U.S. They would love to take over this status. But again, they're probably, you know, reality-based 10 to 15 years away, maybe more. We have to assume China is going to continue up on a straight line and not have any major downside, which history shows that that's not always the case in the world. But much smaller economies still, they have to reduce those capital controls. They have to build a real domestic market in order really to take over this reserve currency status. But I think over time they will be shooting for it.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.